Alrighty, let's go ahead and get started. Welcome everyone to the HUBB Live Trading Room. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like. That's the main point to take away. Other than that, it seems that all eyes are on the PCE report that's coming up this Friday, and to see how that affects the markets thereafter. So interested to get into that discussion with Rob, and of course, very excited to interact with you all. So let's kick off. Rob, you out there?
Hey, I'm Zach. Hey, everyone. Welcome to the HUBB Live Trading Room. Hope everybody's having a great week. Take a look at the chart of the market. As you mentioned, big next report is that PCE report, the Fed's supposed favorite inflation indicator, because now we have to go month to month to see if there's going to be any more rate cuts this year. Data dependent, they're using their catchphrase again. And so that keeps the market kind of on hold a little bit. I did want to throw in there, Zach, that we do have something else to watch on Friday, and that's going to be a conflict. So I think I'll have two TVs going on Friday because we have the start of the Ryder Cup. Ryder Cup. And if you're a golf fan, you know what I'm talking about. It's pretty wild and fun on its own, but being played in New York, it's going to be a spectacle to see. So if you're a fan of golf at all, I'm sure you're as excited about it as I am. But the market will be looking at that PCE report and trying to glean what it's showing as far as inflation. And for now, the market just kind of ticking up this 10-day moving average. Not much has changed over the last few days. We're still running along the 10-day moving average. We did break that 100% extension on this zigzag that I drew. As you know by now, the next level on a zigzag is the next fib level. So you have a 50% B wave correction. You expect 100% extension. If you get an extended C wave, which occurs a lot in a wave 3 particularly, you go to the next fib level. So that would get us up to about 675, which I think will make, unless that PCE report comes in a little bit hotter than expected. If it does, then we'll be wondering, will the market correct a bit? Will it get by this one data point that shows a little bit of an increase in inflation? Or will it view as maybe that means the Fed will be on hold for the rest of the year? So we'll just have to wait and see how the market reacts to it and what the number is, mainly. And if it were to come in a little bit tamer than expected, that could be the catalyst that pushes us up to that 161.8% level, as the market will then be looking towards the next Fed rate cut. So fairly big report coming out on Friday morning. So for now, kind of treading water. Today, we're a little bit down on the day. You can see as I spread the chart out here on how we closed yesterday. Bring that so I can get the arrow back. We did have a higher open and then close near the low of the day right here. And then today's bar is being taken out by that C on the zigzag, but much smaller intraday volatility, although kind of the same thing happened where a little bit higher open and was sold into immediately. We are, in fairness, still a little bit above the 10-day moving average. So we kind of just flip-flopped these first 2 days, Monday and Tuesday. Monday, we open on the low, close on the high, and then we reversed that yesterday. And that's kind of what's going on. Pretty interestingly, I called this yesterday in the Trade Finder rotation roulette that's going on. A lot of conversation, if you watch the financial networks, they've been talking about it a lot, where a lot of short-term moves in and out of stocks. And the good part of it is the breadth is getting wider. They're bringing in further stocks, other than just the Mag 7 or the Big 10 tech stocks, whatever you want to call it. And some other beaten down sectors are catching a little bit of a bid, and that's moving things in a very short-term basis, and then you rotate back around. So it's nimble is what you need to be right now. And I think what that does is exactly what we're here for. It makes things stock picking. It's a stock picker's market. That's what the AI does to help us out. And so more valuable than ever right now in finding places to go. If we take a look at the bond market, we're not going to go through all the markets because we'll do that tomorrow night during our insiders meeting. But you can see furthering how we ended last week after the Fed meeting, where they did do the 25 basis point rate cut, as you know, but the commentary was a little more hawkish, where they didn't commit to any further rate cuts this year. The market's already priced in 75 basis points in rate cuts. And I opined a bit, and I'll talk more about this tomorrow night as well, that the bond market had seemed to be confused as to where the Fed was going to go with all of these consolidating triangles and kind of just staying in a big trading range. They did give a little bit of a nod, the bonds did, on perhaps a more dovish FOMC meeting last week because we had the breakout of this triangle. They didn't get it, so right back down. Remember, prices and yields move inversely. So as prices go up, yields and rates come down. But as prices come down, yields and rates tick back up, which they have, which you would expect if perhaps we're not going to get the same amount of rate cuts that the market has already priced in. And I was wondering if the bond market actually was foreseeing this between a rock and a hard place position that the Fed is in. They've admitted the jobs market is weak. It's weaker than they expected. And they got to keep an eye on that. That's one of their mandates. But inflation is in a little bit higher area than what they'd like. And so what do? Do they cut rates to support the job market, which gives the risk of inflation getting a little bit hotter? Or do they stand pat and wait as the job market continues to weaken, which will eventually weaken the economy? And if they go too far on that road, we have weak economic growth. Then, with the inflation being just a little bit higher, you get the possibility of stagflation. So, still plenty of concerns out there in the market. Other pundits come on and feel like off we go. I heard somebody say that, oh, I forget the phrase that they use, for the next 2 years is going to be off and running because the economy's okay and we're in a some sort of a rate cut cycle. Again, we don't know how much or how fast they're going to cut, but at least they're in an easing posture for now, unless the inflationary data starts getting uncomfortably high. It is a difficult spot for the Fed, and you've heard me before. You know, I'm no fan of the Fed, but I wouldn't want their job right now either. That's for sure. Let's take a quick look at the dollar, which is hovering in there, doing okay. We did break below that 97.5 support level in the Goldilocks channel here, and I don't want to see it continue to tick down, but without the at least for now, threat of more rate cuts. Perhaps the dollar can hang in here. We did take out that July low, but just barely one day, just enough to move that wave 5 over. I just don't want to see it continue down. The PCE report, I think, will have a big effect on the dollar on Friday, depending on how it comes in, unless it's just flat out right in line with estimates, and then it becomes a non-event. But anything on the higher or lower side of the expectation, I think, moves the dollar, and that probably moves the metals. And so we have gold that has really taken off, kind of crazy to see how far gold has gone. You know, we had this move here in a speculative portfolio as we broke from this triangle, and then we had the AI come out and give us a little bit higher signal, which was spot on. We consolidated there for a couple of weeks, and then we exploded again the beginning of this week. Taking a little pause today, but that didn't really mean anything because we were pretty overbought from the 10-day moving average. So you would expect that backing and filling that I talk about a lot once you get too far from the 10-day moving average. So it doesn't mean that this wave 3 is done yet. It just means that we do need to consolidate, and perhaps we do again tomorrow until we get that jobs or that PCE report on Friday. So pretty interesting there. And then silver, pretty much the same story here. Didn't have quite the same triangle, but look what happened on SLV. Remember when that was a wave 5? It's relabeled to a 3. So it seems to kind of coincide with the fact that gold and silver might not be done yet. The metals might be continuing to move up. So I just wanted to point that out. I've been talking about how we had this really nice 5-wave pattern here. That's where the 3 was, and that's where the 4 was. And now all that's been incorporated now into the wave 3 relabeling on SLV. So perhaps it plays a little bit of catch up. All right, so let's go ahead and move over to the AI signals, which is why you're here. And I did want to bring up the fact that we did send out an alert just before we started. You probably have seen it already. I like this one on uranium because we're kind of in that same area of commodities. And with the bid in gold and silver seemingly not done yet, and a little bit of catch-up move here from the uranium ETF, I think this one makes a lot of sense. That doesn't mean a thing, right? And just because it makes sense doesn't necessarily mean it's going to work. It's at a 70% score, which is okay. It's the lower end of where I prefer to send out alerts, but still like it. And I like the story behind it. We did back up a little bit here from the open, so we've already closed a little bit of that gap from the 10-day moving average. And we've got a pretty nice little potential run here from the 60 area up to 67. And then if we look at the DMI, it looks pretty constructive with the ADX just approaching 40. Still good separation between the two directional indicators. We still have the positive moving up and the negative moving down. So that would be indicative of a move higher. And we gave this one, and you know, there's always risk of doing that. We gave this one an extra day or two before sending out the alert because it had just separated a little vertically from the 10-day moving average. And I did take the charts of gold and silver being kind of extreme as well into account in making that choice. But if you've had these AI signals for long, you know that you never know. Sometimes they take off in these momentum runs, and we know that the AI kind of identifies these when they're in a momentum run, because part of the data is when it first labels a wave 3, then it shows up. And that's what kicks in all the rest of the data points. So we've got a wave 3. That's the only part of Elliott wave that it calculates in, but that is one of the data points when you have a new wave 3, and then do the rest of the data points support a continued move higher, and then the score is created. So in general terms, that's how it works. Obviously, we don't know all the criteria because it's proprietary and they don't share everything with us. I don't blame them. It's their intellectual property. So with that, that's the alert that we sent out. It's the story behind that, and we'll see how it plays out. We gave it plenty of time in case we do get a little bit of a pullback on Friday's PCE report, but we're also set if we continue to run higher. The next one on the list from yesterday was MCY. And I thought this one was a little bit vertical as well, but it's also consolidating here. It's a little low at a 68 rating, but with trading around 81 and the potential to go to 90 is interesting. I thought I would look at this one with you. Just when I saw the chart, I said, we'll wait. But then here comes the problem. The options, not really familiar with Mercury General, what they do or who they are. And that kind of ties in with the fact that, well, there's not a lot of liquidity in the options, so not much else to talk about on that front. So let's go ahead and move over to today's list. We'll look at the bearish side, but as you would expect, not very high scores here. But isn't this one interesting? Diageo, which is basically alcohol. And are we not drinking? Or, you know, it's interesting that this is down Maybe if the economy begins to weaker, this one catches a bid. Who knows? This one is close on the bearish side with that 69% score, higher score than you've seen. But again, look at the separation from the 10-day moving average here. I would like to see a little bit of a bounce up here because there's just not enough room from 95 down to 93. Call it roughly $2. It's a hair more than a $2 move. That probably just covers the slippage if there is even liquidity in the option. So I don't know that that one's worth doing anything. But there's, some open interest here, at least enough to where we could find a trade to put on. But I'm just going to kind of keep an eye on that one for the next day or two. If we could get a bounce back up here, ideally closer to 100, but I doubt we go that high. But even just coming up here and testing this level here around 98 or so, that would make this one of interest to put on to the downside. But just once again, right now, just not quite enough room left to risk. And it's just been a straight down move. Pretty interesting to see that. And then if we go over here and look at the next one, the score is a little bit too low. But one of the things that I wanted to highlight in this session is the encouragement of seeing some bearish signals with the scores starting to tick up. They're not quite there yet, but they're getting there. And I've been talking about how much fun it is to trade options on downward moves. And just since we came out of the pandemic, we just really haven't had that many opportunities to trade much in a sustained downward move. We've just been buy the dips has been the mentality. And as I've talked about, that'll work until it doesn't. And that could be setting us up for some really nice downside trades in the coming months. Just whenever the market decides it wants to go through a correction, I like the fact that we're starting to see some decent bearish setups with a correction on the horizon at some point. It may be January of next year, sometime next year before we get there, or it could start Friday if the number is really bad on PCE. So it is a crapshoot as far as when we could see more downside trades, but just excited about the possibility and excited to start sending out some more. We've had very few put side or downside alerts that come out from the AI signals. So that's something to look forward to and get excited about. And the reason I say that is, we talk about how on the upside, some of the trades move very quickly. They continue their momentum run. Others correct a bit, take a little time to get their targets. But on the downside, it's pretty darn fast. And the majority of them are the quick trades. So you'll see lots of 1 to 3 day movements to the downside. That will be the majority of them. And the ones that bounce up a little bit before going lower will be the minority. So it'll kind of flip where we are right now on the bullish side. So something to really be looking forward to. Let's get to today's list. And we'll take a look here. You can see FA on the list here. And we'll take a look at First Advantage. This is interesting. I believe this is a financial, but you would think that with the Fed moving into an easing policy that it would be bullish for the financials. Maybe they were hoping for a little bit more because you can see the breakdown from that support occurred right around when the Fed meeting happened. And again, slightly more hawkishness than maybe they had hoped. And so this movement lower here means to me that either the financials are really stretched on wanting to see rates go lower, or obviously some financial institutions are run better than others, and perhaps there's some behind the scenes issues here. Something to keep an eye on here is the fact that we have this level right here around 14 as support, which is just above that 13 target. 64 was probably a little bit too low. And if we could bounce up to the 10-day moving average, maybe there'd be enough there. If we look at the options to see if there's liquidity, not really. So all that conversation kind of goes by the wayside because not a lot of activity. It's usually when I'm not super familiar with a company, that's what ends up happening on the options is just not heavily traded. All right, let's go back to the bullish list for today. And we do have AM, but whew, nice score, 81. And boy, that makes you want to lick your chops. But there's two issues here, right? One, you already know what it is. It's too far away from the 10-day moving average. I'd have to wait on that one. And then the other thing is it's only a 50-cent move. So we're going from basically at this point, 19 and a half to 20. Once again, not worth it, even with that high score, because in trading options, that kind of a gain probably just covers your spread. If there is even liquidity, yeah, there's plenty of liquidity in this one. So another one I'm not super familiar with, but we can keep an eye on it and see if it backs up a little bit and gives us an opportunity. There's all kind of liquidity here. So a candidate there. And I like to look at the current list with you and just talk it out. So you gain at least my thought process for whatever that's worth on deciding whether to send out an alert or not. And so that's a little bit too vertical, but if it does the same thing that URNM did, perhaps tomorrow we could move in there, but I'd like to get at least $1 move. So I'd want to see it come down. Maybe we don't make it all the way back down to 19, but you can see this was a strong level of resistance. We did have a bit of an ascending triangle here too, moving into that resistance area. And that's why we get this big move because it broke through resistance and there was probably some short covering involved in here with people that had their shorts right there at resistance. Perhaps it comes back down and tests that and allows the 10-day moving average to catch up. Maybe they have a meet and greet there at 19, and that could be an interesting one in the next day or two. But with just 50 cents left, et cetera, not really worth looking at. And then looking at American Mobile, AMX, used to trade that one a long time ago, quite a bit. Just zigging and zagging, right? The beautiful zigzag pattern all the way up. Really like that. Almost a stair step pattern as well, but maybe just enough of corrections that they're more zigzags than stair steps. But great looking pattern here, zigging and zagging up here. At 69%, it's kind of on the borderline, $20 to 22, about a $2 move. Let's see what the options look like here, if there's any liquidity, and not much. So yeah, and without even, it doesn't even have leaps, and that means because there's no January options. We go from November to February. That's normally a telltale sign that it's not going to be super liquid in the options. But the bid ask isn't horrible there on the 21 strike, 90 cents by $1.15. It's a little wider than our 10% rule, but if you could get a decent split fill there, maybe it would be worth it. 200 contracts with open interest. So it's a possibility there. I'll do a little bit more work on this and see, but that we'd have to get a good fill there, but I'll take a look at it and perhaps that comes out, perhaps it doesn't. I think maybe we can find some better ones, but I really do like the zigzag patterns in the wave three. I like that we've come back down towards the 10-day moving average. Perhaps we look to see if we can turn around and bounce from that level. So there's some positives there. It's kind of a potential candidate. It's not a glowing one, but there's lots to like. And then we always want to look at that DMI and see, does it support a further move higher? And the one concern here was as we were continuing higher, and granted, they were zigzags, so there were corrective moves in there, so that may have thrown the reading of the ADX off a little bit because there was so many zigzags in there that we kind of went boom, boom, boom here. But a slight divergence there on the ADX as the stock was zigging and zagging higher. The ADX was kind of zigging and zagging lower. So a little bit of divergence, but still constructive because the ADX is moving up. It's still above 25, still between the two directional indicators, still decent separation between the two directional indicators. And just as a reminder, when I'm looking at the DMI, obviously it's not the greatest thing to see the positive directional indicator coming down, but it is having a move back down towards the 10-day moving average today. And that's going to happen. You can see, I mean, oftentimes these two directional indicators, because they are very day-to-day responsive to what's going on with the underlying, that's ticking down, but we're not getting a corresponding tick up on the negative directional indicator. So as I've talked about in the past, but for those of you that may be newer, this indicates just kind of a pause in the buyers. The buyers are taking a break, but the sellers aren't stepping in. So it's not that we're getting increased selling pressure and they're kind of pushing the bulls a bit. It's just the bulls or the buyers have stepped away a little after yesterday's move. So again, a borderline there, possible alert. We'll see how that plays out. And then if we're going to look at a 68 score, we might as well look at STRL as well. Got a little bit away from the 10-day moving average, quickly back down today. Now here's the opposite on the DMI. So that wasn't planned, but that worked out well. Where you have the tick down and the positive directional indicator, but this time it's corresponded with a pretty good tick up in the negative. So there are some shorts that are at least testing the water here. But you can see sometimes they do that and then they fall back when they realize, oh, the buyers are still there. So notice right here, we had this downward move in the positive directional indicator, upward move in the negative, but then the positive turned back up. So the sellers said, oh, buy, and they went running away. So that's what I mean by testing the water. We never got the cross at that point in time. We've got a ways to go before they would cross here. So it's interesting that they're kind of testing it now. You would think the positive directional indicator would be a little bit lower, but perhaps they're emboldened by the downward move today. But it is a higher dollar stock, so the movements have to be taken into account with the fact that with higher dollar stocks, you can get some more volatility. Not sure about the options here. I am familiar with this, but I don't know if there's a lot of open interest. It's fair. We do have leaps down in January, but those are low on open interest. Maybe December is better. Not really. So probably not one to send out an alert on here, but something for you to keep an eye on. And then just to continue to learn on the DMI, keep an eye on those two directional indicators and see what happens. Trying to give you a few tidbits there. And then going over to the bearish side. I mean, we already did that. Going to the wave 5 bullish, I meant nothing there yet. But once again, as I was talking about, we will correct at some point in time. And we're going to have some downside trades. And as the market, even now, you're seeing those higher scores come up on the bearish side, getting some 5-wave patterns to the downside, which at some point will begin to correct and move back up. And we will start to see more wave 5 bullish signals. They just really haven't been any because the market's just been on this melt up mode. So not too many 5-wave to the downside patterns that are ready to reverse and head back higher. And then going over to the quiet area, which has been the sideways stuff. If you've been watching that, there just haven't been a whole lot here. And that's going to change, I think, in the not too distant future as well. So once the market does start to correct, which is kind of interesting the way the signals work, and it's by design, we'll see fewer and fewer wave 3 bullish signals, a lot more with higher scores on the wave 3 bearish side. We'll see more of the wave 5 bulls, probably a step behind the wave 3 bullish stuff. But as we start to correct a bit, the market's going to be really expecting things on earnings. And when they disappoint, boom, they come back down. And I know this one gets asked about. What show is that? Zack, is it our Monday show? Is it Thursday night? I think it's maybe during Insiders. We've been asked about this, I think, the past 2 weeks. And look at that, vertically up, vertically back down. And it's down far enough that it actually showed up in the drop scenario here from the AI, but the score is too high for a contrarian trade, which would be some sort of a strangle or something for a breakout, and then the stock price is too low. But it really tried to get above 10 and it couldn't hold it. Does it come all the way back down to 5 before trying to mount a bounce? We'll see how much the institutions that bought it once it got above 5 want to come in and support it here. So I think you kind of wait and see on this one. But then when we go back on the calendar, there's just not a lot to take a look at. That NEGG, you can't figure out what it wants to do, and shows up on different searches. So just kind of ignore that one for now. And then this would be pretty interesting if the score was higher, but also at $10 stocks. So almost in the exact same boat as open, where tried to push itself above 10, couldn't do it, and got sold into. And that's something that some of the short sellers watch for, because they know the significance of that $10 level. And if they see a stock trying to approach it, they'll watch and see the volume. There's a lot of volume come in. If not, then they feel emboldened to try to push it back down towards 5. So that's what occurs there. Just a little tidbit there, that the shorts watch that $10 level and see what kind of strength it has, what kind of volume comes in. They'll stay away if volume jumps in above 10, meaning that more investment companies that have growth as their investment objective can buy them above 10, and then you get a whole lot more potential volume. So the shorts will stay away from that in the early part. But if the volume doesn't come in, just like you saw on open, they'll step in. All right, with that, Zach, we got about 10 minutes to go, so we'll go ahead and take a few questions if there are some. Don't really want to spin about the markets too much more at this point, because we all know that Friday could change things. So it seems like we're always looking forward to something.
Yep. Yeah, it sure does seem that way with past weeks in recent time. But yeah, as you said, it sure could change everything. Let's get right into it. Couple symbols here from Alexandru. First one's going to be Broadcom, AVGO.
I haven't looked at that one in a while either, so let's take a look. Was trading that quite a bit not that long ago, and then that happened. You got the big move higher, and then we've corrected that overbought scenario. Hopefully, you're all seeing enough of these examples of the separation from the 10-day moving average rule, going too vertical too fast, all those things that we talk about so often. You're seeing example after example after example on these. Now we want to see if it can hold itself here and not go down and fill this gap at this point in time. So the start of this big gap up, that low is what you want to see it hold. If you're long, I wouldn't get out yet. It's certainly concerning that we're below the 10-day moving average, but your stop's pretty close, so no reason to get out yet. But if it breaks that level, there's a good chance that it's going to come down and at least get close to filling that gap. So at that point in time, you might want to step away and wait for another entry. If you're looking to go long, you want to see it bounce off this level and get back above the 10-day moving average first before any sort of attempt long. Next one.
Thanks, Rob. Next one's going to be NTR.
Yeah, that one's having a nice breakout day today. We have that one as a strangle, and hopefully that continues. It's a good start to the breakout. But I'm going to show you the opposite side of the coin here with our twin butterfly that we'll talk about Thursday night as well. But yeah, nice start to the breakout there. Look like to see a little, even a one-day continuation here would probably be enough to where we could take that one off. But that's what we hope to see with those triangles. You don't always get those big breakout moves, but nice so far. Just a little bit of follow through there would be golden. So on SH over here. Taking a look at this one real quick. Started off the same way with the breakout move and then back down. I'll get it right. Spotify. I knew there was a P in there somewhere. Here's what I wanted to show you. There's the twin butterfly position, and that one-day breakout looked great. And then we're right back to the point, testing the 50-day moving average today. It's probably confusing if you have this in your account because brokers don't know how to value this kind of trade. And so, it looks like you got a big gain one day, a big loss the next. They're all over the place. Just don't pay any attention to that. You can't lose more than what's in the trade. And then we will wait and see if we get a breakout move. And then when we take it off, then that's where things play themselves out. But attempted breakout, no follow through day. The three ways that stocks break out, remember, sometimes they break out and take off, and that's it. Sometimes they break out, test the breakout, and then run. And then other times, this is a false breakout, which you have to respect when there's no follow through day, and then the big move is lower. So those second two scenarios are still in play here. The one thing we do know is it wasn't a breakout and take off. That would have been nice, but actually, the closer you get to expiration on one of these moves, the better the butterfly works, which is one of the great things about a butterfly is it balances out time decay. So with that, we'll just wait and see. We don't care. Just let it tell us which way it's going to go. But anyway, I wanted to show that and then give a scenario that we hope doesn't happen in NTR. Hope that one gives a follow through day and take a nice gain and move on.
Thanks, Rob. Question from Renal on CHW, watching the calendar spread alert.
CHW here on good old Chewy. Moving back down here. So so far so good. Went up to the upper boundary, coming back down. Love to see it head back down towards 35, but for now, looking great.
Alrighty. Next up, we have Maria. Riot moved really quickly this morning, and I missed it. So in that scenario, just hang on to it.
Yeah, that one really did. But look what happened, and you had to be pretty quick. It did give a couple opportunities, but yeah, when you see something like that, it's going to get sold into too far from the 10-day moving average too fast. That's why we wanted to take it off. And I know there was enough time, so I'm sorry you missed it, Maria, because I wait until the alerts are received before I execute my trades, and I was able to get out at more than what the alert was sent out at. But then pretty quickly after that, I understand we had to be pretty quick on the draw here, but hopefully others made nice gains. So yeah, at this point in time, I think I would watch it. It's a little nerve-wracking that the high was so close to the AI target, but this could just simply be too far, too fast. We're still well above the 10-day moving average. We're above where the entry was from the AI. So I would just hold it and see what happens over the next couple of days. Even if it comes a little bit lower here, as long as it holds above that 10-day moving average, perhaps we could come back. It's just going to have to be one to watch over the next couple of days. But if I was still in it, I would stay in it.
Very well. Thanks, Rob. A follow-up question from Maria is, I know you aren't sitting watching just a few stocks all day, so how do you set alerts on the trades to know when the IV is spiking? Thanks.
Well, to be honest, I have my watch list that I prepare similar to over here, and so I have charts set up and just go through and look at them each and every day. And I've been asked that question before. There's no real rhyme or reason because a big spike is different on all stocks. But when you see an outsized move, and I think you've asked me about that before, like average true range, et cetera. And when you see a move that's outside that, that's a good indicator that there's going to be an IV spike. So if it makes a move during the day that's outside its normal range, extra volatility is put in then without having to do any sort of real significant options analysis. That's a good general rule that tells you there's extra IV in there. Usually we find out when if we don't take it off and the stock goes a little higher the next day, and yet the call option's worth less than the previous day, and then that was an indication, oh, there was extra IV in there. But that's a good way to have an idea. But I don't watch the whole market. I have um, around somewhere in the area, on average, about 20 stocks that I'm watching. So it's not a real extensive list. The ones that I'm really interested in, and just keep an eye on them and watch their intraday moves to see, especially on the open, like this one, just opened here and took off in the first hour of trade. And then the shorts saw an opportunity. The shorts are feeling a little more emboldened here to step in and take their shots here and there, as we've seen a good indication of in this webinar today. So, right.
And this one's going back to URNM from Jim, asking about the lack of liquidity.
There's enough though, especially on the strike that was sent out. Um, if we take a look at the options and we go to January, you know, there's there's good open interest um, in several of the different strikes there. So just depends on where you are, but yeah, there's enough liquidity there for that one.
Alrighty, thanks, Rob. And right at 45 minutes, that wraps up all of the questions for today's session. So I'll pass back over to you.
All right, sounds good. Thanks, everybody. Hope you enjoyed the session. Again, always try to throw some little extra educational tidbit in here, especially when there's not a whole lot of signals to look at. But excited about the increase in bearish signals, the scores, and the potential moving forward. I think it's going to be exciting next few months with the alerts. So hope you're as excited about it, and look forward to talking to you again, perhaps in the insiders meeting tomorrow night. Take care, everybody.